last week, a couple weeks ago, we talked about a very mom and pop style operation.
Yeah.
This is now true, like big corporate international tenant or national tenant.
Now, granted, you could apply some of this in smaller cities. You're going to get way higher cap rates, but that's reflective of the risk. Welcome back to REI Hot Seat. Andrew Hines here with Jacob Campanaro. Today we're doing a nuts and bolts episode. We're getting right into it. So we're going to be talking about doing an analysis of a commercial industrial building, no specific subject property, but going through some of the terminology. And this all stemmed from a couple of weeks ago. We did an episode where we didn't quite get deep enough into the numbers because it was sort of new concept getting into commercial industrial. So
we kind of threw it out there. Obviously, historically, this podcast has been multifam, but we've received a lot of inquiries on the podcast, outside the podcast, saying, hey, we want to know more about retail commercial, industrial commercial, even just mixed use multifamily. What does that look like? We had a lot of positive feedback on the last video we did, which was super high level, just introducing the concept of commercial. What we're going to call commercial. And so in this episode, I want to do, as we promised, a little couple part series here about this. So for today, I wanted to do basically just a run through of what are we looking for when we're acquiring these properties. So we've done this multiple times with multifam. It's like a quick DD, how to dive into it. How is it good? Is it good? Is it bad? What do we do? Commercial's a little bit more complicated, and I wanted to keep it nice and basic today. We will bring a deal in next week to actually run through. But for people that are just getting into this, and we'll get more advanced as we go, but for people just getting into this, let's start with terminology and where the bare bones start. How do you get this done?
Yeah, so key takeaways that somebody who's watching or listening is going to have would be what from this episode? Just an understanding of the base terminology, the topics you need to know about. Understanding,
I'm interested in commercial. I found a deal. Somebody sent me a deal. My realtor sent me a deal. What do I do?
So somebody who watches this might be able to start an analysis on a deal.
Correct.
Okay.
And I have the sheet up that's on the screen right now. Obviously, always happy to share this with people. This is basically our public-facing Performa for this type of asset.
Can we get is there a URL that we can share for this? Or?
Yeah, we'll put it in like a Google Doc or something, and people can go download it.
Okay.
For sure. So, okay. So I get Andrew sends me a property and says, hey, Jake, you should check this out. It looks interesting. Okay. Why is it interesting? Right. We're going to dive into that. And so with commercial real estate, the first thing I always do is, we're going to start with the basics of investing. We're going to look at location, right? What is the location of this property? We would do the exact same thing with multifamily. All right. Is this a location I'm interested in? Do I want to invest in this area of town, this province, whatever it may be? And that's more specific to the purchaser themselves. I can't answer that for you. But things we like to look at, I think we touched on this last time, strong economic factors. What's the tenant, right? What is the tenant base? What's the tenant mix?
So when we were talking about a commercial industrial before,
correct.
If somebody owns a building full of a bunch of that, you're typically going to have your plumber. You might have some small manufacturing operations. Yep. I used to work for a little electric motor shop back when I was 18 that ran out of one of those type of locations.
Exactly. And so today we're going to talk a little bit more about retail commercial, because last time we talked industrial. And so with retail commercial, what comes to mind when you hear that, right? One portfolio I was just looking through the other day was a portfolio of Shoppers Drug Marts.
Yeah, which would be considered a very strong tenant, obviously, with Loblaws owning them now.
Correct, right? So it was a single tenant portfolio. So basically each property had one tenant, which was Shoppers Drug Mart. They were purpose-built buildings. The tenant was there for 10, 20, 30 years in some cases. And as we'll go to dive into, the leases were renewed. So there's a lot of newer leases on these properties.
Does that type of tenant stick around typically? I mean, obviously they've invested a lot probably in leasehold, but the landlord also maybe invested a lot in it to try and get them. So
yeah, and it depends, right? Usually with Shoppers, they're purpose-built.
Okay.
Like you look
They're
at a
purpose-built
shopper
for that tenant.
Yeah, you look
that
at a
tenant
shopper.
says, I'd like a
correct. So
building,
usually
you build
they tend to stick around.
and you negotiate something that makes sense for the landlord, and then you just hope that they would renew. But
correct.
At that point, they may want further improvements, leasehold changes.
Yeah, which is part of the game.
Like what would a lease typically be for something like that? A ground up purpose built.
Yeah.
What would it be? 25-year lease?
So you're jumping ahead a little bit of where I wanted to be, but good question. No, but it's good. I like it back and forth. So we talked about location. The next thing we want to do is tenant mix, tenant profile. What do we have? On a single tenant building like Shoppers Drug Mart, they're a publicly traded company. It's quite easy to look into. How are their stocks doing, right? Yeah. Is there news about Shoppers closing down here and there all over the place? What is the tenant like? Is this a strong tenant? I would say yes, it's a very strong tenant, which actually comes up with some of its own issues, which we'll talk about. But for somebody like Shoppers Drug Mart, I'm going to go check out their stocks. I'm going to check out the news about Shoppers Drug Mart, and I'm going to get a general feel for it. For example, back in 2021 or 22, the beer store ended up selling off all their locations across Canada.
So they sold them, but they're still tenants.
They're still tenants. So what they did was, and it was very interesting, is at least it's speculative, but they saw the writing on the wall that beer was going to be allowed in grocery stores, variety stores, gas stations, things like that, because this was coming for a while.
Yeah.
And I think they knew that their market share was going to get eroded by that. So what they did on a genius move by them is they actually re-upped for a 10-year lease on all of their locations across Canada. So they said, we're going to basically, in their opinion, they're going to phase out over the next 10 years. So they did nice new leases, put the rate where they felt they could support it, but it was also nice and high, and they sold every location off based on a cap rate on their own lease rate.
Oh, on their own lease.
Right.
Yeah, okay.
So they basically, like, I don't want to say they juiced it. Like, I feel like they were market rates, but they got top of market rate and then sold everything off and made
So they made a bunch of money on the real estate.
That's correct. So that was a pretty cool play on their part. So anyways, back to this, right? Like the beer, if I was looking at that beer store portfolio, I would say, whoa, why are they selling every location? Understanding that these things are coming in. So these are things to look at and consider, right? Last week, a couple weeks ago, we talked about a very mom and pop style operation.
Yeah.
This is now true, like big corporate international tenant or national tenant.
And if you go with that type, obviously, there are risks. The big risk I would see is just like a Shoppers or a beer store. I mean, maybe not so much now, but for beer store anyway. But just feeling like they're in the driver's seat, they can dictate terms, and you don't really get a say. Their offers are more take it or leave it, and just try me because there's a million other people who want my business.
Right, and it's funny you say that because I was on a call with a client, and that was the exact concern he brought up, and he was like, "Jake, I love it. It's a great portfolio, but what happens when renewal time comes? Am I just going to sit it down at the table with 6 lawyers and just get destroyed?"
Right. What are you going to do if you've got that purpose-built shop, right? I mean, I guess with something like that, you got to kind of look at their track record. Do they have a reputation for doing that with landlords?
Correct.
Because that would follow them too.
Correct.
So
and this is something that we as commercial realtors help with. Like, this is part of our job, is we do tenant and landlord negotiations. We do all of this work. So bring us in, right? Bring a lawyer into the meeting. There's ways to get around it, right? It's just like if you're selling your company, are you going to just sit down at the table with the buyer and say, okay, let's sell the company? No, you're going to have your lawyers and your accountants and your sales agents, and you have your team, right? That's what they're there for.
Yeah.
So anyway, so back to where we were. So we got the location, we found the tenant, we've reviewed the tenant. We say, yes, we want to take on Shoppers Drug Mart. We like them. They're a good tenant. We feel they're going to be in this market for a long time. The next thing we're going to look at is lease term. Even before we dive into what the lease rate is of the tenant, is I look at lease term. Do we have 1 year left, 10 years left, 20 years left on this lease? That's the most important part, because that is directly tied to the value of your property. Right.
And what if it is 3 years left with like a Shoppers Drug Mart tenant?
Yeah. Well, do they have an option to renew? Right. So we want to look at what the term is left and what their options to renew are.
Yeah.
Because if you have renewal options, most likely a tenant like that is going to re-up. They're going to take the renewal option, and the only thing you're then negotiating is price. Right. What's market price? Because all the terms of the existing lease are going to stay intact on that renewal period. So something to consider.
So prices to be negotiated.
But there's ways to look at it. So like when I'm working with a client and I see a 1 year term on a deal. Like we either have two options. We're either going to walk away because there's too much risk to take on a tenant with a 1-year term remaining, or we're going to negotiate a renewal as part of our purchase.
Yeah, so just approach that tenant.
We'll put that right into the agreement, right? We will purchase, but it's conditional upon us renewing for a 5, 10, 20-year lease with this tenant.
Yeah.
Because that's what we're expecting to. We're buying on a cap rate. We want to honor that cap rate moving forward. So that's the third most important thing in my book is what's the term. Once we have the terms, then you can dive into other items like what's the base rent, right? What are they paying? And when it comes to commercial, there's a couple different ways to price your units. So there's triple net carefree. We can call it triple net not carefree or double net, or we can call it gross or semi-gross. There's a whole bunch of different terms, and we'll go through these terms, right? So the holy grail of rental is triple net carefree, right? And so this is when you have a single tenant like Shoppers Drug Mart, for example, it is the tenant's responsible for basically everything.
Yeah, they do all the maintenance. They
the
pay
roof
the
goes, they
taxes.
fix it. The boiler goes, they fix it. They're
pay the
paying property
tax.
taxes. They're paying insurance. They're paying everything. The only responsibility as a landlord, you have your management of the tenant, so property management, and you're going to have your mortgage.
Yeah,
and basically everything else is covered.
That's pretty sweet.
So that's what everybody listening is going, yeah, that's what I want. I'm tired of dealing with tenants. Give me something that I can just set and forget. Right. And these are rarer, right? Like usually we find this when you're looking at single tenant, international tenants, or larger tenants that take care of the property. You're dealing with mom and pop. It's very unlikely you're going to find a triple net carefree.
Yeah.
Right.
So what's triple net not carefree?
Triple net not carefree, double net, whatever you want to call it, essentially is there is a base rent, which is going to be the per square foot or the dollar amount you're paying to rent the space. And then there's going to be a TMI and or CAM charge.
Okay.
And so TMI stands for taxes, maintenance, and insurance. Okay. So your property tax, a proportionate share of property tax, proportionate share of property insurance, and proportionate share of maintenance of the property. And that can be snow, landscaping.
Yeah.
That can be other items. CAM is common area maintenance. It's just a different way of calculating, but it's basically the same thing, right? So what's the cost of running this building?
Okay. Isn't that essentially working out the same? Or you're giving them a flat monthly fee for it?
No, it's basically the same thing. It's just a different term.
So
right?
double net is similar to triple net then?
Right, but you're charging back, but you're responsible to take care of everything.
So that's the double net version.
That's the
triple net carefree you're talking about. Is you don't actually do anything. There's no financial transaction for you to bill it back.
No, the tenant is responsible for everything. And then within that triple net not carefree, so what we're talking about, which is your most common lease. Right, your most common lease is you, the landlord, is taking care of snow removal, landscaping, property management, property maintenance,
it all back,
and building a proportionate share back.
With the idea it's going to be reconciled at the end of the year. It has to be fair.
That's correct. And that's written into your lease agreement when negotiating with the tenant. Now, one thing to also write into your lease agreement is maybe the landlord's responsible for when the roof goes, but you can actually charge back expenses. You can charge back CapEx. Okay. You can amortize it. So essentially, in a lot of larger leases, for example, we're doing one with a grocery store anchored tenant, multiple tenant plaza. The roof went on the grocery store. So the landlord covered the cost of the roof. They're paying for it, $250,000 to do the roof, large roof. But now they're actually charging back to the tenant every year a portion of that until it's paid off.
The interesting thing about that would be is if the roof is over the grocery store specifically, it's still going to be split up among all the tenants to pay for it, but proportionately. So
not necessarily.
If the grocery store is 90%, wouldn't they just pay 90% of that expense and all the other tenants cover the other?
So in some cases, yes. In other cases, not. So again, with commercial leases, it's contract law.
So it's whatever you wrote in. So
this,
some of them might say that if something happens on the grocery store's roof, you just cover it yourself.
Correct. I've actually had somebody negotiate that with me on a deal recently. They said our proportionate share and our CapEx recovery is going to be for our specific square footage of a unit. Anything outside of that is not our responsibility.
Gotcha.
Which I think is a great way to negotiate that as a tenant rep. right?
Yeah.
As the landlord, it's better if you can spread that across everybody, because then you don't penalize your one tenant for having a bad roof. But in this case, the grocery store being 90% of the plaza, 80% of the plaza, it was written that the grocery store was fully responsible for that roof. So the cost of that was amortized. Now, they amortized it over the term of the lease, which was 10 years, right?
Yeah.
So the landlord's charging back X amount every year for 10 years and charging a small amount of interest on it, right, for inflation.
Interesting.
So, again, I don't want to send people down the rabbit hole. This can sound complicated sometimes.
Well, you're obviously going to just work with competent professionals. That's the key with all of this. You don't try and invent the wheel. Go work with people who do it all the day long.
Exactly. Right. So, and this again is something that's in the contract. It's black and white, and that's what I love about it. There's no landlord and tenant rules, right? It's hey, this is what's in the contract. We're charging you back for the roof. Done.
Random tangent though. Do you think Loblaws is the owner of Shoppers? Do you think they own their own locations, or are they renting their
I don't think they
locations
do.
too?
My understanding is they rent all
They rent their locations.
Yeah.
That's crazy. Purpose built.
Yeah. Right.
Those are some big locations.
Again, just riffing on that tangent quickly, I had an email this morning come in. I have a client that owns a development site in St. Catharines, and they're going through and building an apartment building on this site. But I actually had a representative of Kentucky Fried Chicken reach out to me this morning. Mm-hmm. They said, "Hey, Jake, we saw your client owns this site. It's right next to a Wendy's. We're actually very interested in building a Kentucky Fried Chicken here. Would they be interested in entertaining that?" And basically how that would work is Kentucky Fried Chicken is going to do a land lease for the site. Then they're going to come in and build their own unit.
So leased land owned building.
Correct. So it's going to be a 10, 20, 30-year lease with the right to build and do the zoning for a KFC, and then run and operate that KFC over the next X amount of years, right?
Why wouldn't they just want to own the land? It's so weird.
Well, it's just how you run your business, right?
Yeah.
So, for example, McDonald's owns a lot of their sites,
Yeah, they own their land.
right? McDonald's owns a lot of their sites. I think Chick-fil-A owns some of theirs as well.
I think McDonald's is known to be like one of the biggest landowners in the world.
Correct.
Yeah.
And so it just depends on what the model is, right? A lot of companies say, no, we want to lease. That's our, we write it off. That's what we do. We don't want to manage and own the real estate. We're here to make cash flow on the business, not on the real estate. So it just depends on each company. So some do, some don't. Beer store owned everything. Then they cashed out and sold.
Yeah.
So each to
Makes
their
sense.
own. But yeah, the KFC thing was really interesting because now we're working through that to say, we're actually performing it right now to say, okay, if they build their apartment building,
Yeah.
what is more profitable, to have a 30-year lease with a Kentucky Fried Chicken or build an apartment building?
Oh, yeah. Well,
So they're pretty far down the pipe on building. So they're like, more than likely we're just going to build.
yeah.
But they are entertaining the KFC angle as well, which is cool.
Very cool.
Right? So these are things to keep in mind. Okay, so now we've looked at the bare bones, the basics of these properties, right? We have location, we have proper tenant, we have the basics of the lease agreement reviewed. So we understand that is a downtown Toronto Shoppers Drug Mart on a triple net carefree lease, right? Just to quickly touch on it, gross lease means it's one fee for everything. There's no TMI,
Yeah.
right? No utilities. And then semi-gross means it's one fee for everything, no TMI, but the tenant does pay utilities or a share of utilities.
Okay.
So when you hear all these terminologies, just flip me a message.
So the gross lease is just your all-inclusive rent.
Correct.
Which
Which is-
as a student rental landlord, I did that for my students. We had all-inclusive,
Yep.
electric, water, gas, everything paid for.
So, for instance,
Just pay
you'll
one
see
fee.
gross lease on mixed-use apartment buildings quite a bit, right? So think
Okay.
downtown Toronto or downtown whatever city, a couple units above, retail on the main floor. Usually those are owned by landlords that don't want to have to deal with figuring out TMI and CAM and all of that.
yeah, well, I was
right?
just going to say it's way easier from an accounting standpoint to just charge one fee to your tenant and then make sure it's enough to cover
Yeah.
all your expenses.
Right. And again, it also depends neighborhood to neighborhood, location to location. Like if you are in a neighborhood that everybody's doing gross lease and you go in there thinking you're going to do triple net carefree, good luck.
It's not a good idea to do
Right?
that
It's
either.
just not going to work. Like the tenant's not going to take it. No one will lease that space. So it's also area specific and
So
location.
what's customary? And you don't want to be a unicorn in any area. I don't like unicorn properties. So
No, right? So, but again, in typical true commercial fashion, it's usually triple net, not carefree.
yeah, commercial, that makes sense. Obviously, residential, you're going to see more of the all-inclusive or gross idea.
Yeah.
Okay.
So we have all of that. Hopefully you guys are following along. I haven't bored anybody yet to turn off the TV, but so that's our bare basics. Now we can dive into the lease agreement a little bit further and understand the nuances of the lease. And so I have on the screen here, and we'll jump to the. So now on the screen here, I have a rent roll, which are kind of the bare basics you need to understand to do to review a lease agreement. So within every lease agreement, you're going to have the unit number, you're going to have the tenant's name, who's the tenant. We're going to have the gross leasable area. So that's important because that may differ from the actual size of the building or the size of the unit, because you could have something
common
hallways, things like that. So what is your gross leasable area? When did this lease start? Way back. Who's the, so for example, that Shoppers Drug Mart we were talking about, their lease actually started in 2007.
Yeah, okay.
So they've been in that location from 2007 to now and just renewed for another 5 years. All right. So when is that lease going to end? So now you're going to look at the most recent amendment and you're going to say, okay, we just re-upped for 5 years, so now we're good till 2030.
Gotcha.
So from 2007 to 2030, these are good numbers to look at, right? They've been there for a long time. They're established in the neighborhood. What is their rent per square foot base? And what is their rental escalations, right? So that's the next very important thing here. Commercial lease agreements have rent escalations built into the agreement. So when Andrew and I are negotiating our deal, we're going to sit down at the table and I'm going to say, Andrew, you're going to start at $15 a foot, but I want to see $1 a year of increase for the next 5 years.
Okay.
Or 25 cents a year or 50 cents a year. It can be whatever we want to negotiate. There's no 2.5% cap on this stuff. Again, you don't want to scare your tenants off.
Yeah, you're most likely going to end up doing something like in line with inflation.
We usually do about 2.5, 3%. On desirable areas, we can go 5% escalations, right?
Yeah, especially if you think it's an up-and-coming area. That makes sense.
So, for example, Shoppers Drug Mart was 25 cents. No, sorry, I'm getting confused. Shoppers Drug Mart was $1 every 2 years.
Per square foot.
Per square foot. So an additional $1 every 2 years per square foot for the next 5 years.
And they'd be in how many square feet? Like 25,000?
Something like that, yeah. Right? So that dollar counts, right? So that's your rental escalations. You're going to want to find that. Other revenue. Are they renting parking? Is there storage? Is there anything else that's bringing revenue in on the site? A lot of commercial properties, maybe a billboard.
Yeah.
They have billboards. They have radio towers. These are more common with this type of property.
Cell phone
towers, right?
Yeah.
So check your other revenue. Look through that lease agreement. What else are they renting? We want to figure out our annual rent. We want to look at our estimated recoveries per square foot. So recoveries is that TMI, CAM, the roof, whatever. So how much are they paying in recoveries? All right. Other recoveries being, again, if you want to talk about the boiler broke or the roof went, you can put that there. And then we have renewal options. So is the last thing we want to know. So do they have another 5-year, 10-year, 20-year renewal?
Yeah.
So if you can figure that out in the lease agreement, and most agents will actually have this information public because it's fairly basic and it keeps you from reading a 52-page lease agreement, right? So they should have
they're going to have the
lease
basics.
Summary.
Yeah.
A lot don't.
Well, fortunately, in the day and age we live in, you can just throw a contract into ChatGPT and ask questions.
There you go. Right? Honestly, it's the best thing you can do. Just flip it in there.
I usually just throw one of the incognito because I don't want it to save the information.
Yeah.
I'll just ask it questions. Oh man, does that ever speed things up for contract review? Yeah.
So that's all in all the basics of, is this an investment I want to look at? So you can tell it's a little bit more intensive than multifamily.
Yep.
But
which is sort of a barrier to entry and an opportunity.
Right.
Yeah.
And so that's what we would look at, bare bones, to say, okay, Andrew, here's an investment we found. It fits your criteria. It has the market you want, the tenant you want, the lease agreement looks solid.
Yeah.
Let's now dive into an actual Performa and understand, does this property cash flow and is your return on your investment where you need it?
Right.
right? So now we'll dive into the Performa. So this looks a little different from what you guys are used to seeing. We're going to Performa these things out over a 5-year or even a 10-year term, depending on what the renewal period of that deal is.
So for the Shoppers example, you would only go 5-year?
I'd go 5-year.
Okay.
Right?
Yeah.
Because basically what we want to look at is what is our return on 5 years? Because those 5 years are guaranteed.
Yeah.
It's contract. But they might not have to renew. Right?
They don't have to. And the question is, what would you do with that building if they didn't? Like, who's going to be the tenant that comes in? Are there a lot of used to be Shoppers Drug Mart buildings out there that we can refer to? I don't feel like it's very common.
They really stick around.
Yeah, they stick in one spot.
That's the thing about Shoppers. Like they're a pretty solid tenant.
And why would they want to move? Because once they're established in an area, they don't want to just, people drive there and, hey, where's Shoppers? They're known to be there. That's people drive there automatically.
Well, they establish themselves in these neighborhoods as nodes, and that's it. They're the pharmacy, right?
Yeah, the pharmacy and grocery store.
Yeah, everything.
Yeah.
So again, it's unlikely, but again, that's why we're going to run it 5 years and say, okay, in 5 years with buying this building, have I hit my targeted returns I'm looking for, right? And then,
yeah, but I mean, is there a concept of like salvage value? Do you ever get into that, like where it's like we're not sure whether we can use this building again, or there's going to be some use, it just might be at a lower rent?
There's definitely going to be some use.
Yeah.
But this is the thing, right? We got to look at, have they overinflated the escalations?
Yeah.
Right. Are escalations outside of market?
Okay.
Right. Which we've seen a lot in the office space, for example. So we did deals 4 years ago, 3 years ago. The office market was much better. Right. We're putting in 5% escalations for office space.
Okay.
Right. There's tenants in office buildings paying $30 a square foot when market is 10.
Yeah.
Because they're stuck in these contracts that they signed.
Is it really 10?
No, but
depends on some places.
I'm trying to be. I was being dramatic. Yeah, realistically, there's a lot of office in Burlington. Let's say is going for somewhere between $15 and $18 a foot.
Gotcha.
That's office. B class, A class can go 19, 20, whatever. But there are tenants that are paying 10, 20, 30% over market.
Yeah.
In these buildings.
Makes sense.
And
you're saying that would be a concern.
That would be
if your tenant is in there because you're basing your numbers based on the tenant, but they're already paying over market.
Correct.
And you don't want to have to deal with something that's way over market when you go find a new tenant.
Well, it could be great for 5 years.
Yeah.
We're making hand over fist, but now all of a sudden 5 years comes, they're going to go to renew and they're going to say, guys, we're paying 20% over market.
Yeah.
Right. Is that 20% hit to your bottom line? Is that going to change this investment for you?
So you got to be realistic about that number.
Right.
And then no, it is still a chance that they leave. Maybe they have a new plaza opens up, or there's a new slightly better location nearby. You do kind of have to be ready for that. But if you're in a prime area, what are the odds somebody else comes in there? I think it would be high.
Right. Well, and it's an interesting topic, Andrew, because that's where we boil down to cap rates versus risk factor.
Like what kind of risk am I taking? You'd expect a higher cap rate on something like this because there's always that risk. It's not like with multifamily, like people need a place to live. Somebody's going to live there. Whereas with commercial, like they don't necessarily need that space. There could be a better, more accessible location. But I mean, there's still a use for finished space.
There is.
Finished space will always have a use.
And so that's why we do see, on average, higher cap rates in the commercial world, right? Like the Shoppers Drug Mart, the Carefree triple net lease was like a 6.25 cap. In a pretty good location.
Yeah, and that would be a lower cap rate just because people love Shoppers Drug Mart.
Correct. I think. We've seen tenants, we've seen some of these deals go at 7-8% caps because they're just in riskier areas where there's likelihood that tenant may leave. Right, so you got to buy it at a point where hey, we can come down 10%. We can sit on the market for a year trying to find a tenant. Yeah. But I still got a good building.
I'll give an example, and we both know this one in Wyerton, the old grocery store. I feel like they should shoot. They should shoot zombie movies there.
Yeah. Well, supposedly that's going to be the new city hall.
Right. So this goes back to the point. Somebody's going to acquire the land. They're going to put something there. It's it's right in town. But it's just funny, like the grass growing up through the asphalt, through the parking lot because nobody's been there. I just looked at it. I'm like, you could totally shoot a few scenes for.
I'm sure they have
for the next Zombieland there.
Yeah. Well, that's it, right? So, anyways, due diligence. Like this is. You're in a different industry now. It's not multifamily.
Yeah.
Well,
the example I just gave, that's like a small town, tertiary market at best. So like that's not like this, what we're talking about, large city commercial. Now, granted, you could apply some of this in smaller cities. You're going to get way higher cap rates, but that's reflective of the risk.
Yeah. Right. And then there's again, I don't want to ramble and go on too many directions, but it's like, small city retail like this, okay, let's say the tenant does leave, is there an angle to convert to residential? Right, that's another thing to look at.
Yeah, I was thinking about that too,
episode.
and that is an angle, and that's a for real angle. I know a guy who did a conversion on the old newspaper building in St. Thomas.
Right.
So you can take, industrial buildings and make them residential.
Right.
You got to do environmental testing, make sure it's safe. There's part of the conversion for the site plan to do all that stuff, but it could be done and could be done in here. Although you'd probably want to change the facade if you're turning our shoppers into a...
Hopefully.
and you'd only really have main floor units, but you could do upstairs as office space or something.
Yeah, exactly.
There's an angle. Like there's always an angle.
Yeah. So very quickly, just to wrap things up, we've been going for 30 minutes now. And I know everybody's...
Yeah, we don't have a specific example here. This is just like a pack full of information episode. So
I just wanted to get most of this out of the way so that going forward, we don't need to explain these terminologies and these items when we're looking at deals. Because I do want to bring in a deal next week. And when we're going through and saying triple net lease, CAM, TMI, this, that. Yeah. If you have questions, you can come back to this episode.
The reality of YouTube land is we're going to get people coming in who's never seen us before. But we'll work through that. Yeah. We'll definitely pace it, and we'll remind people where this video is.
Yeah, exactly. Yeah. So just wrapping up. So this is our Performa, very basic, same as your multifamily Performa. You're looking at your total revenue minus your expenses. So in here, you'll see that we have rental revenue, outdoor parking, a couple examples, other revenue. We have I'll just keep zooming in here. We have your expense recovery. So we have your CAM, administration fee, amortized CapEx, and other. So these are items, again, administration fee, that's your time to do this.
So it's something you just bill contractually, it's built in.
Yeah, a lot of professional landlords, they'll charge up to 15% administration fee to manage the TMI and the CAM.
Okay.
Right?
Yeah.
Because this is a net item.
Yeah, you
can't profit off of CAM.
But you can have an administrative, which you would need to, because that would be
you'd lose money
coming from like having done this on an individual like duplex unit and like billing back water and how annoying that is. Like, you need somebody, an assistant, constantly managing that.
Yeah, you need a fee here, so make sure you don't short yourself on that. So then we're going to take our total revenue, and this is important. A lot of listings I see out in the market, they'll just show the rental and they'll say, oh no, it's triple net, like all the expenses are covered, so we're not even going to show you the expenses. Here's the base revenue, that's your NOI. Right? Which I have a huge issue with. Like, we need to know the numbers. Doesn't matter if it's recovered or not. I want to know how much you're recovering.
Yeah, because there's a cash flow
well, because if you're showing if it's fully covered and your recovery cost is $15 a square foot and the market is $10 a square foot recovery, you're going to lose your tenants. No one's going to want to stick around. Your recovery cost is too high.
Yeah, so you got to make it reasonable.
So now are you adjusting your base rent to make sure that your recovery cost is covered?
Yeah.
That's going backwards, right? Because we're not making money off the recovery.
Yeah, okay.
So that's something to keep in mind. And then we just run through our operating expenses, right? We got our vacancy, property tax, insurance, repairs and maintenance, property management, utilities, and other. That is really a comprehensive list. If you like repairs and maintenance, you can get all your landscaping, your snow removal, everything, your utilities, if you're paying for them or not. So a lot of these times, these expenses are going to be rather light.
Yeah.
Just because of that, because again, you have those recoveries.
So I mean, in terms of a financial statement, you wouldn't actually see anything for repairs and maintenance if it had been recovered, even though you're paying for it on an accounting basis, you're getting it back, but you're just zeroing the account as you recoup the cost.
Correct. And that's the way I want to see it on the Performa as well, right? Like show the CAM charge and then show exactly what those CAM charges are being charged for.
Yeah.
And then
So you just want to know, is their maintenance too high? Because then you won't be able to keep your tenants.
Correct.
So even though you're recovering it, they still got to want to operate there.
Yeah. And at the end of the day, hey, if your net operating income matches your total revenue, cool. Like you're recovering everything 100%. You're in market. Life's good.
Yeah.
Right. So just again, things to keep an eye on while we're running through this. So
are you saying it would be normal for in the course of operations to have something that doesn't go recovered, or there's a few miscellaneous expenses at the end of the year that didn't get recovered?
It depends on how that lease agreement's written, right? There's a lot of times where tenants say, no, I'm capping my recovery charge.
Okay, so there might be an overage
because recovery technically is a floating number.
Yeah.
Right. We'll wrap up with this, but it's a floating number. So as your expenses fluctuate, that number should fluctuate. There's been cases where your recovery number actually goes down because your maintenance, you have a better maintenance contract, your landscaper's cheaper, right? And now your tenants are going to benefit from that.
Gotcha.
So, as a prudent landlord, you should always be trying to reduce those recovery costs because that could actually increase your base revenue. Right? A lot of tenants look at, what am I paying monthly? What is my monthly fee? They don't care about TMI and base.
Yeah, how much are you getting? Just how much am I paying?
How much am I paying at the end of the day? So if you can bring that recovery down, bring the base up, you put more in your pocket. So be prudent. Sense. Don't just find the first contract because it's easy and your tenants are going to pay for it. Like, that's a very bad attitude. And that's the thing about a commercial. You have a bad attitude, it's going to come back to bite you. Right? Like, you do have to be doing good business, and you have to be a prudent landlord.
Yeah, makes sense. All right, guys, that was a value-packed episode. Obviously, tons of information from Jake, and sometimes it's a little tough when you don't have the example, but we did bring in some examples here, so hopefully that helped drive it home. And then, of course, actually going through this would be the next step. So why don't you let us know in the comments if you want Jake to dig in, and we actually run one of the examples here on the show. And I'm sure we'll get some yeses on that. And then, of course, as always, once you've done that, if you want to have access to the insider deals for the REI Hot Seat insiders, make sure that you join through the link below the video on YouTube or in the show notes on any of the podcast platforms.
Yeah. Thank you very much. And I'll just say a little tidbit teaser before we go. So next week, we have a deal that's actually mixed use. So it's residential and commercial. Dave's going to be on, and Dave and I are going to talk to our respective parts about the building. So it's going to be an interesting one.
All right. Sounds great. Guys, thank you very much. We'll see you again next week.
Thank you.